All right, good morning, folks. How are you? So we're looking at the NASDAQ here, and this was Monday's trading. And I gave you all these levels yesterday, and I told you this is the lay of the land. After a geopolitical event like we saw over the weekend, it's important to just sit still and watch and observe. And it's not farm payroll week, so right away, there's a lot of things stacked against you in terms of precision, low resistance liquidity runs. So we're more likely to have high resistance liquidity run conditions this week as a result of that. It's the beginning of the year. Deep pockets, large institutions are apprehensive right now in terms of allocating new funds, and that volume coming into the marketplace is not being yet inspired. So, not that that volume is pushing price, by the way. You're being lied to today. So, the idea of where the market may open and trade after Maduro's snatching in Venezuela over the weekend. We had that happen here at regular trading hours, opening range gap high. The low on Friday's settlement is down here, as I showed in the chart yesterday. So I posted a chart and labeled it on X, lay of the land, meaning that this is kind of like where price is going to remain until we get something significant enough to push us outside of it. Because on the daily chart, you can see we haven't really done much so far for the year. So we're still inside this sloppy range here. So you have to use the wicks. Okay, so having those graded, knowing that they are, and on the lower time frames as well, it'll help you navigate, or at least provide you a reason to sit still. Okay, so I want to show you, if you haven't already annotated your charts based on what I shared yesterday, and these are all levels, none of these levels except for those two blue lines, which I'll show you what they are in a moment. None of this is any different than what I shared on X yesterday in the post that says lay of the land. So just look for that post from yesterday and you'll see all these levels were there in advance. Okay, so here is the business from yesterday. There's our opening range. And we didn't get any fair value gaps until 9:52 right there. So it was a buy side imbalance, sell side inefficiency. And then they came down and they didn't show any respect to the upper half. They just sliced right down through it. And the way I teach order flow, the way I use these PD arrays is we want to see how price is. If it's bullish, it's going to stay in the upper half and stay out of the lower half. Did we get that? No. You can see that they went right through it. The body already went outside of it. And then the second candle's body was outside of it. And then all these wicks down here. The only thing they're doing is referencing that wick. So already order flow is proving to you that it is high resistance. Precision is going to be fleeting. So that means this is going to be a pure run on liquidity. So what liquidity is residing? What was the first run? From here down. So they're taking advantage of the sentiment idea that they think that one man who has very little significance in our world or the globe, really, an illegitimate president who stole an election, got snatched up. Okay. There's a lot of things that can be said about that and how I think that's going to cause things to go forward. But as it relates to one man having an impact on our market or causing a sell-off, it's not germane to the storyline. So, but they used that idea to lure people into thinking it's going to go down. Engineering liquidity right at the high of the opening candle at 9:30. That just so happened to ping last Friday's first presents a fair value gap, which is a level I gave you before it traded there. So the market does in fact create that first presents a fair value gap. It gets ugly in here telling you it's going to be a run on liquidity. Who's profitable right now? The shorts. So that means the buy side is the target. The market runs up. trades into consequent encroachment of last Friday's first percent to fair value gap. Sells off a little bit, uses the low. Price meanders around the regular trading hours or the opening price at 9:30. High. Comes back, clears this high here, goes up to upper quadrant of Friday's first percent to fair value gap. And then ultimately sweeps it above it with the wicks, but notice the bodies stay inside. So that means if we take that low out now, it's going to look for discount arrays trading back inside of the regular trading hours opening range gap. We come up, tap it twice here, dig back down into the regular trading hours opening range gap, drawing back down. I sent the tweet. You can go back and look at it. I said that we've had 4 highs form above regular trading hours opening range gap high. 1, 2, 3, 4. I'm classifying these 2 because they're relative equal as 1. So 4 times it pressed higher just to get into last Friday's first percent to fair value gap. I didn't have anything higher than that in the lay of the land chart. And that was the high of the day yesterday right there. And I mentioned that we would go back into first percent to fair value gap. Meandered in here and drove down into it and then hit our grading levels. Go back and look at the chart. You'll know what these levels are. And then one more time, sweeping that low here. This fair value gap there is me highlighting this to my sons because it's the principle I already taught you now. Buy side above that high is pierced. The first percent to fair value gap that happens there, that you want to use that. So where is liquidity at? Here. Here. Market uses it. Look at the bodies. Beautiful. And both liquidity are taken. And then we came up back into first percent to fair value gap. Stayed around inside of it. Hit that same fair value gap after buy side liquidity pool, purge. Nice sell off during London from the low down into an inefficiency there. Uses the low, the first percent to fair value gap from Monday. Remember that one up there is Friday. This one here is Monday's. So again, it uses it. Consequent encroachment, the low, sells off, taking the relative equal lows over here. Using the gradings on the Fed that we applied to wicks and whatnot. And then at 8 o'clock last night in Asia, we pulled right back up into Monday's first percent to fair value gap. And look how price was held inside that range. Traded up into that first percent to fair value gap after the buy side was taken. I noted that with the blue lines here just a moment ago. Used the high of it, pushed up into yesterday's regular trading hours high for the opening range gap. Back up into Friday's first percent to fair value gap's low. And then they send it lower, diving back down into gradient level that I teach. It was in your chart that I shared yesterday. And I just moved that. I'll put it back. And then now here, you can see we had prices hugging around Monday's first presented fair value gap, just really not showing any kind of, I guess, preview of what to expect. So everything that I gave you in that chart yesterday, those levels are still salient for today. Okay, so that's how we would use it. The only thing we would add to it in addition to would be simply adding whatever opening range gap for today is, and whatever first presented fair value gap that forms for Tuesday's trading. Otherwise, it's pretty much more